Offshore Voluntary Disclosure of Income, OVDI. So this past June, there have been some major changes which provide more flexibility and make it more attractive for taxpayers to come forward regarding their unreported foreign financial accounts. And the IRS's intention is to encourage both U.S. taxpayers inside the country as well as outside the country to come clean, to disclose their accounts and to pay their U.S. taxes. And they also recognize that there are some individuals out there who are not doing so willfully, that they perhaps didn't know about the tax rules and now they're getting nervous because they've heard about it. They feel they should do the right thing. So they're trying to come up with a little bit more of a balanced approach. And they've made some changes to the streamlined procedures. They've introduced a streamlined foreign offshore procedures for what they call U.S. non-residents and streamlined domestic offshore procedures for U.S. non-residents. Now, for the purpose of OVDI and the streamlined procedures, residency is determined differently than it is under the Internal Revenue Code. So when you're looking at this, you have to totally forget what residency rules are for U.S. tax and just look primarily at what the criteria are under the streamlined procedures. So for example, you could have a U.S. green card holder who is a U.S. resident for tax purposes under the Internal Revenue Code, but for the streamlined procedures, they could actually be considered to be a non-resident. So to qualify as a non-resident streamlined individual, the taxpayers must meet a non-residency requirement, and I'll go into a little bit later what that is. And if you meet the non-residency requirement, if you have a spouse that you're intending to file married filing jointly with, your spouse must also meet the non-residency requirement. To meet the non-resident foreign offshore requirements, you have to have failed to report income on a foreign financial asset or have failed to file a foreign bank account reporting form, and your non-compliance must be due to non-willful conduct. And we'll talk a little bit later about what non-willful conduct is. So the non-residency requirement for streamlined purposes, what that means is that U.S. citizens and green card holders, for at least 1 year during the 3-year period that they're required to backfile their returns, they have had to have an abode, a place to live outside of the U.S., and they must be outside of the U.S. for more than 330 full days. So these U.S. citizens, green card holders, they can't be in the U.S. for more than 35 days in the year. And the reason behind that, we're presuming, is that the IRS is considering if you're in the U.S. for more than 35 days, you should know better. So you can't say that you're a non-resident and be living in the U.S. for that period of time. So the resident streamlined offshore procedures, to qualify for that, you have to fail the tests for the non-resident requirement. Again, if you have a spouse and you're filing jointly, if your spouse doesn't meet the requirement, then the other spouse does not either. So it's kind of like an all or nothing. To be a resident streamlined domestic offshore person, you need to have filed your tax returns in the prior 3 years, failed to report your foreign financial assets, and again, be non-compliant due to non-willful conduct. And an interesting thing to note for these resident streamlined domestic procedures is that the case of snowbirds. So if you have an individual who's both a U.S. citizen and Canadian citizen, so they live in Canada for most of the year and then just slip down to the U.S. for the winter months, you have to really look at the requirements for these resident procedures, because if these snowbirds haven't filed 3 years of tax returns, then they don't qualify for the resident streamlined procedures. So then they might think, okay, well, I can disclose under the non-resident procedures. But for the non-resident procedures, you have to be in the U.S. for less than 35 days. So it's not that difficult for a snowbird to actually be in the U.S. for more than 35 days. So for these individuals, they could be out of luck from either streamlined procedure, in which case they have to go through the OVDP procedures, which has a greater penalty as well. So just to talk about, once you've decided if you fall within the resident or the non-resident streamlined procedures, what do you need to do next? What are the steps? So for the streamlined foreign offshore, the IRS has eliminated the requirement for the taxpayer to have $1,500 or less in unpaid taxes each year. They've eliminated the risk questionnaire that the taxpayer was required to complete, and they are now requiring the taxpayer to certify that their non-compliance is non-willful. There are no penalties. The taxpayer has to file the original or amended returns, including all of those information returns for the past 3 years. And if they have the foreign bank accounts, they need to file the original or the amended forms for the past 6. The resident domestic procedures, again, just remember that this is not U.S. residents as defined under the Internal Revenue Code. It's you have to look at the streamlined criteria. Again, there's no requirement for the risk questionnaire or the $1,500 or less of tax that's been unpaid. They still need to certify that their conduct is non-willful. But unlike the non-resident procedures, the U.S. taxpayer is subject to a penalty, and the penalty is 5% on the aggregate year-end balance or value in all of the accounts. And the resident taxpayer would also have to backfile the returns and the foreign bank account reporting. So there are individuals who don't qualify. In addition to the snowbird example, there are individuals who cannot qualify under either the streamlines. One situation would be where the IRS has initiated a civil examination of a return for any tax year, or if the taxpayer is under investigation by the IRS, or they've already submitted a voluntary disclosure letter on or after July 1st. If a voluntary disclosure letter was submitted but it was before July 1st and a closing agreement was not yet received, the taxpayer may choose to disclose using one of the new streamlined procedures. So if a taxpayer is considered to be willfully non-compliant and can therefore not use one of the streamlined procedures and has to go with the OVDP, the penalty can be increased from 27.5% to 50% of the values of the assets if it's been publicly announced that the IRS or the Department of Justice is investigating the financial institution where the account is, or if they're investigating a party that's helping facilitate the accounts, and if the taxpayer hasn't submitted an OVDP pre-clearance request. And this is all assuming that the IRS does not know the taxpayer's name. So if it's been announced that there's some investigation taking place, the penalty is increased if at that time you come forward. So the IRS has used willful and non-willful conduct, but they haven't gone into much detail as to what that means. So it becomes a challenge for tax advisors who are trying to assist their clients to determine which method they can use for disclosure, and are their actions willful or non-willful. So you need to look at the facts very carefully to determine if the conduct was due to negligence, an error, inadvertence, or just a good faith misunderstanding. And then if you and your client decide that the conduct was non-willful, the next question would be, would the IRS come to the same conclusion? So if you are going to go with the streamlined procedure in saying that you're non-willful, you better be prepared to explain why. And it's not even just a matter of are you willful or non-willful. What about willfully blind? So the IRS will also look to see, you can say that you were non-willful in your conduct, but should you have known? So are you deliberately, as a U.S. person, avoiding learning about the rules? Because the IRS would then say that, well, you're willfully blind and you should have known better.